Zacks Know Your Options, a weekly overview of unique option strategies and ideas designed to help you beat the market no matter which direction it's going. All right, this time, as far as Know Your Options is concerned, we're going to be talking about volatility. Kevin Matris, who's our top market technician and options specialist here at Zacks, is going to fill us all in on everything you wanted to know. Well, almost.
Well, at least one thing.
Yeah, about
today at least.
About volatility.
Right.
So markets have been volatile lately, although things have slowed a little bit in the past few days.
Yeah, indeed. The market has been crazy volatile. It has kind of eased up a little bit, although it may be kicking back into gear. But today I want to talk about options volatility and what it really means for the options investor.
Okay.
So why don't we just start off with the definition.
All right.
Volatility measures the rate at which a security moves up and down. If a security is moving up and down quickly, volatility will be high. Conversely, if a security is moving up and down slowly, volatility will be low. Options volatility is largely pinned to the underlying stock. So traditionally, an options trader will look to buy options when volatility is low, since premiums will be lower. Traders who are writing options, they are generally looking to write options when volatility is high because premiums tend to be higher. Of course, the trick, like anything, is trying to figure out whether or not volatility is high or low.
Right.
But if you're buying an option with low volatility, you want to see volatility increase because that will fatten up the premium, and vice versa when you're a writer. You want to see options volatility decrease because that will shrink the premium, thus increasing its profitability. But I do want to say before we continue, volatility is just one thing to look at when putting on an options trade. You do not want to be putting on an options trade solely because an option has a certain volatility. That would be a mistake. But understanding how volatility can impact your options prices, that's important to know.
So it's sounding like to me, although it doesn't mean much that it sounds like this to me, but volatility can be a good thing.
Yeah, depending on what kind of options trade you're trying to put on. So for instance, volatility too, it's one thing being able to figure out how expensive an option will be or how cheap an option will be over time, but volatility can also be used as trying to figure out if something big could be getting ready to happen in the market. What's interesting is that as option volatility is low, usually that is when things start to happen. It could be signaling a big move is getting ready to occur. Because interestingly enough, when volatility drops, usually the market isn't doing much, people aren't really paying attention, nobody is expecting anything to happen, and often that's when things really explode.
So it's a signal.
Yeah, it can be used as a signal. The smart options trader, though, recognizing that, he's going to be scanning the environment, looking for those low volatility things, hoping to see the volatility increase. Now again, whether he's bullish or bearish, he can take advantage of low volatility by either buying calls or buying puts. Mm-hmm. Because in addition to seeing the option premium increase because he is in the right way, he's picked the correct direction of the trade.
Okay.
He's also going to see the volatility increase, which will fatten up the premium. The reason why this happens is this. As volatility increases, the likelihood of a rapid advance or larger price swings has increased. That also means that the likelihood of an option trading in the money at expiration has increased as well, making his chances more valuable, making the option more valuable for the buyer. Conversely, the writer of the option, when he sees the volatility increase, he is going to demand a higher premium because now he is taking a higher risk. He's taking the other side of the trade. Mm-hmm. So there is a higher chance that the option he wrote will expire in the money, thus reducing his chance for profit. However, though, if you were to look at the other end of the spectrum,
okay,
when volatility is high, excessively high, the option writer is looking to write options here. The market is full of traders, everybody is in, people are expecting big things to happen. Usually that's when things don't happen, right?
Right.
And the option writer, he's hoping the market is either going to pull back or he's hoping the market falls into, let's say, a lull or a trading range. But either way, he is looking to cash in on these high premiums because he's hoping that the volatility volatility is going to decrease, thus increasing his chances for profiting. So, in this environment, volatility shrinks. The probability of large price swings has also shrunk as well. The option writer is going to benefit because the chances of him retaining all of that premium is good. But for the option buyer, the chances of seeing that option expire in the money has also been diminished. So his chances are worse, and that's where the dynamic comes into play. Whoever has the higher chance of profit is ultimately going to pay more, right? So if you think there's a higher chance for profit, you're going to pay more for that opportunity. And again, if in fact you're on the other side of the trade, you're going to command a higher premium for accepting that kind of risk.
So let me see if I understand this. The buyer wants to see volatility trend up, but it's preferable to get in when it's low.
Yeah, and that is correct. Conversely, if you're looking at the other side, the writer, after volatility has trended up, he is hoping that volatility is in fact going to go down. Once again, that is going to shrink the value of the option. I think a great way to really wrap your mind around volatility is to think of it this way. If let's just say that you have a security and it's at $50,
okay,
and let's just say that the volatility is 20%. That means that there is a greater likelihood that that security could trade within a 20% range, 20% above 50 or 20% below 50. So if volatility has increased, that means the person who is buying an out-of-the-money option with increased volatility, for instance, or I should say, you want to get in when it's low, but if you see the volatility start to increase, that means the chances of that option getting in the money at expiration is greater because there is a greater likelihood that the range will be bigger. So I think a great way to try to understand volatility is to think of that. That is basically what a security could trade above or below a certain price. Now, the next time we're here, though, or the next time we talk about volatility, I'll try to talk about volatility in a more practical sense and how you can use it to pick the right kind of trade.
All right. And if you are accessing this video outside of Zacks.com, then you'll want to get over to our homepage because along with all of these videos on options, Kevin does have a text piece that appears as well. And if it is more beneficial to you to view what Kevin's talking about in text form, there's where you can find it. Zacks.com, scroll down the page till you get to our options section, click on that headline that's right there, and it'll take you to this information in print form. And so we've learned that volatility is not always a bad thing. Just another lesson for you to help you know your options. With Kevin Matris, I'm Terry Ruffalo.